it's our belief that also that investors may be at risk investing in companies whose business models are weak and weakening further. And really at a certain point, and it's reflected in this curve, valuation doesn't matter, because even a small step back in a weakening company that continues to get weaker, you can still lose a lot of valuation under those circumstances as well. So we try to avoid what we think are weak industries, weak business models, even if there's an opportunity for a short-term change in the business. That said, we won't completely avoid what we think are very difficult businesses. Some cyclical business, for example, we own oil and gas land drilling contractors. It's a very difficult business. Virtually every risk known, every business risk one can think of, whether it's labor risk, commodity risk, cyclicality and capital intensity. So we give that group of companies probably a C or C minus as a fundamental kind of business. I mean, they're probably one step up from owning an airline. So very, very difficult business. But they also have volatile stock prices connected to them. Sometimes they get so mispriced in the marketplace that we will implement a position, again, provided that the balance sheet's strong enough to carry the business plan out. At those times when the cycle is so out of favor and the stock prices are so out of favor, we may have a very small position in a C minus company where we think the fundamentals are likely to improve, even if it is only a 1 or 2 year holding. We think of those kinds of investments as traders as opposed to compounders.